Hello and welcome to Fireside with a VC. My name is Andrew Romans, and today we've got a different cool episode. It's actually a video and audio recording of the Venture Capital Insight panel at the 7VC event we hosted at Pillsbury's offices in New York City earlier this month. So we've actually got like a full stack of talking to seed funds about investing in pre-product, pre-revenue, how to set valuations, all those dynamics, up to late stage expansion growth capital including secondaries and not getting ROFR'd and all the dynamics of rights of first refusal and SPVs. So we're really kind of cradle to grave looking at the venture capital ecosystem with a deep dive on New York City. And the event was actually sold out. We had 120 people in attendance. More than 50% of them were VCs, corporate venture capitalists, family offices, angel investors, and LPs. And we're doing that same event next week on April 4th in Seattle. We've got 6 VCs on that panel coming up. There's plenty of time for networking, the VC panel. A couple of our portfolio companies present, which I took out from this video just for compliance reasons. And then we have like at least 2 hours of networking with an open bar, really great canopy, hors d'oeuvres and food, and free copies of my venture capital book. So join us. Good to get out of the house and into real networking and listen to some real content. So enjoy the video.
So my name is Andrew Romans. I'm a general partner of 7VC Venture Capital. It's great to be back in New York. Ron and I were saying all 4 of my grandparents are born in Brooklyn, so this is a baseline of culture. But we're short on time, and I really love an event that's got some great content, but the biggest thing is the people that are at the event. I think this is almost an unusual group of more than half the people here are venture capitalists. We have family offices here. We've got LPs here. I've been meeting a bunch here this afternoon, and we've got some great founders and some important service providers that are the glue of the ecosystem. So I was actually working with one of our portfolio companies, NeonVest, which is really, really cool company. And I said, you talk about CAC to LTV, like what's the cost of acquiring a customer and how much money are we going to get out and what's the payback? And I said, if you guys started doing events like the way I used to do events, you could have like a negative profitable CAC just by getting VCs and founders in the room together. So that was a bit of the inspiration. Also, I'm a Silicon Valley transplant to Austin, and I walked into someone's dinner party and ran into Lakshmi, where she said, "Oh, we'll do it. We got a perfect office for this." And so this wouldn't have happened without her. So shout out to Lakshmi, and thank you so much. She's a Stanford, like all-American tennis player, truly history-setting woman. So that's pretty cool. Also, Pillsbury, I've got a bit of history with this law firm. I started my first venture-backed company in the mid to late 90s. And my law firm was Pillsbury Madison Sutro. PMS, great acronym, should never have changed it. But now it's just Pillsbury, and great to be working with you guys. And so the agenda for the evening is we're going to thank a few people that have helped make the event possible. We're going to go through our VC panel, which is really cool because it covers all stages of venture. And then we're going to open it up to questions from you guys. One rule is if you pitch your company in a question somehow, you'll be asked to leave. So that's not acceptable. You can pitch your company. We're going to ideally have at least 2 hours of networking infused with drinks and food to enable you to pitch all you want at that point. And then we've got 3 amazing portfolio companies that we're honored to be investors in that'll give kind of bullet presentations. And I always say, who cares about all the worthless VC roadkill? It's the actual operators that are the talent. So we're going to see the actual 10-foot tall NBA players, telling us what they're working on. And then it's back to networking. By the way, networking, I think, is just so important. I think if you're developing any single ecosystem like New York, it's super important, but it's also important to get people from outside to like get some fiber links into that. And one thing I really preach is that try to spend 30% of your time doing favors for other people that you get along with, asking for nothing in return. And your remaining 70% of your time would have a minimum 2x, more effective rate of getting stuff done, and maybe even a 5x. So you're at 1.4 if you're only a 2xer. And when you meet someone tonight, you're more engaged to listen to what they're doing and what they're working on and think, how can I help that person? Just makes for a way cooler networking, and that's the magic dust that's like arrogant to call it Silicon Valley because that's everywhere now. But first, allow me to introduce Ron Fleming, not Ian Fleming, but Ron Fleming, who's a legend. And I like to joke that Ron is an investment banker masquerading as a lawyer because he's done so many deals, been through so many good and bad things that it's more than like, we're going to do your cap table for $2,000 an hour. So with that.
That's fantastic. And Taylor will do your cap table for $2,000 an hour, not me. Great to meet everybody. I'll be very brief here. Blessed to be part of this ecosystem. I love telling people when I'm on my Zoom in my home office that, you know, people all assume this was all here. And I could assure you, and I've met some others that I first met 25 years ago in the room here, on the panel here. 25 years ago, the entire ecosystem that we all love and take for granted could literally have fit in this corner. I mean, there were a handful of what they used to call computer law firms. It's kind of comical, but we are where we are, and blessed to be part of it and to watch the biggest engine in New York City. The idea, even now, just for fun, that we're in New York City, that New York could be the second biggest ecosystem for technology in the universe, and even, you know, I don't know if there's any Boston folks in the room, but bypass Boston. We might not be so good in sports down here, but we did bypass Boston in technology a long time ago. So we'll take what little wins we can get. Pillsbury, kind of for fun, we incorporated Intel in 1968. We set up Kleiner Perkins 1. And when I started as a lawyer here, there was no such thing as NVCA forms. The 2-volume treatise, which still gets published written by a bunch of our partners, was the Bible for the industry. So kind of fun. We are where we are in New York City. Business Insider is one of our claims to fame from being there from day one with Henry Blodgett and Kevin Ryan and others. MongoDB, ironically, when that was first put together, thought it had to be bi-coastal just for optics because everyone thought you couldn't start a software company, a real enterprise software company in New York City. Guess what? They were wrong. So here we all are. With that, thrilled to see the energy in the room. This is one of several events we've already had this year. We had 200 people here for the digital health thing a few weeks ago. Everyone's back. Thrilled to be back. And I don't believe any of the headlines. We have never been busier with real good. There's something called bad busy for those of us that were around in 2009, doing down rounds in 2003. I will say, and our team out here in the audience can confirm, happy and blessed to be doing good busy. So with that, here we go.
Thank you. Okay, Bryce from Fidelity. Fidelity doesn't buy companies very often, but when they do.
Thanks. So if I did this 6 weeks ago, I would have introduced myself as Bryce Del Grande, head of sales and go-to-market at Shoebox. But now I get to introduce myself to you all as the VP of sales at Fidelity for private markets. And so I'm excited to be here for several reasons. One, because yes, Boston is a better sports town, and I'm sorry. And two, because New York City and the ecosystem is thriving. And we're super excited as Shoebox and now Fidelity to be a part of that. Shoebox historically has supported companies, venture firms, limited partners with equity, cap table, reporting, and so on. And now as part of Fidelity, we're doubling down, tripling down, quadrupling down on that mission to be here within the private markets, within venture capital, through events, through our platform, through our team. And so couldn't be a better stage to say, hey, we're excited to keep growing this all with you.
And would it be fair to say that you guys compete with Coda?
That would be fair.
Yeah, so I think monopolies are great if you're the owner of them, but it'd be nice to see Fidelity enter the game. So I think that's it's really exciting to see you guys here. Okay, and Boris from Salsa Mobi, are you here? Thanks. And we're thanking these guys. These guys are sponsors. And by the way, we're offered we're an energy drink. We want to sponsor your event. We're like, no. It's got to be content that everybody cares about. Like there's a competitor to Carta and it's called Fidelity. So here's another cool one.
Thank you, Andrew. I'm actually Boris from Austin as well. So great to be here. And I don't know if this mic is on, but I got to speak a little closer. Yeah. All right. I haven't done these like Andrew has many times. I'm honored to be here. I have a network of senior software engineers all over Latin America. So we help startups and growing companies with great talent. I'm actually originally from Ukraine. I grew up in the US and I've been a CTO, VP of engineering at multiple companies. I've had kind of a technical background and I've built a great network of engineers that I'm now enjoying helping other companies in doing so. I am also an angel investor, and I mentor at various accelerators around. So I love these events. I love the pitches and the ecosystem that you guys are helping to make great, especially with your help. Thank you.
I mean, I can't tell you how many times I meet a founder, either that we did not invest in, that says, we're struggling to hire a CTO, we really need that, or our CTO quit. And so the idea that you can get one maybe in Latin America and then build out a whole team, what they're getting paid in USD, that's amazing. And if they raise kids in Manhattan, that's going to be a tough one to, balance your budget in a time of austerity. So hey, Akash, Surya, which one of you guys are going to represent Neon Best quickly here?
Appreciate it. And I know everyone wants to get to the panel, so I'll keep it brief. I'm the co-founder of NeonVest along with Surya over here, where basically founders use us for one primary use case, to supercharge their networks to VCs and founder operators. And the reason they do that is to really scale their network and get access to sort of mentorship and domain expertise via one-on-one 30 to 60-minute video chats. Andrew led our last round. We raised seed last year. It's been a great journey so far, and he's the one who actually introduced us to these sort of in-person events and how it can help scale our customer base. So with that, I mean, we're rolling out a promo tool over the next 2 weeks. So any founders that you guys know or anyone who wants to take advantage of this, we have about 500 superchargers on the platform today, and it's mainly for office hours type formats. We have Bessemer, PayPal Ventures, Samsung Catalyst Fund on board. So if you want to get access to these guys, join NeonVest. Thanks.
Well, so I guess I am speaking my book if I say anything about NeonVest, but Brad Feltz is a friend of mine from Founder Group. He also has written a bunch of books, and he talks about the importance of having office hours. If you don't do that, you end up with, a bunch of white guys from Boston that you went to business school with, and that's your only 7 to 7 Zoom schedule. Whereas he insisted on having office hours of 2 hours on Tuesdays and Thursdays, where anybody that can get to his office in Boulder can pitch him. And David Cohen kicked in his door and pitched him Techstars. And so it's an example of serendipity happens when you open up your network a little bit. And so I think that NeonVest is kind of serving that function. And it feels good to mentor a founder quickly over Zoom and then see how they're doing in a year later. And, it's kind of like a magical safe place as opposed to, look, man, I'm busy, I'm running out of time, I'm not going to invest in you. Here's 2 bits of thoughts and get out of my way. And then they hate me and it's just bad. But okay, enough of that. So we're going to dive into the panel. And so think of some smart questions for us. But why don't you guys each introduce yourself? Andrea Lamari from MVP actually flew in from San Francisco. Don't let that Manhattan Venture Partners name fool you. Why don't you give yourself a quick introduction? And before we do, I mean, you'll see this in a second. We've really got the whole from early stage to cradle to grave venture capital ecosystem on this short panel. So it'll be a fun conversation.
Awesome. Well, thanks so much, Andrew, for having me and everyone. It's so awesome to be amongst friends, colleagues. I've known Lakshmi for years, Bryce, the Shoebox team, big fan. So yeah, I'm Andrea. I actually did fly in from Puerto Rico this time, but I typically would be in San Francisco. So I am a general partner at a late stage venture fund called Manhattan Venture Partners. We happen to be headquartered here in absolutely Manhattan, if you can catch the name. We invest in companies once they hit a minimum of $100 million in revenue. So we are looking at companies that are at a growth trajectory, single digit, profitability at this point. They're high flyer names that have top tier venture backing. What we like to say is our secondary business is primary and our primary business is secondary. 80% of the time we're going in via secondary transactions and then building up our position by way of a primary round of financing. We also wholly own a broker dealer, so it allows us to act as traders as well as VCs, which is pretty interesting. So it allows us to really get price discovery on late stage venture names. Prior to becoming one of the general partners on the firm, I was at Carta. I spearheaded the launch of Carta X. Prior to that, I was at the NASDAQ Stock Exchange. And before that, I co-founded a company called Forge Global, which is a marketplace for private company stocks. So the world of secondary transactions, definitely in the DNA.
Wiz.
Hey, I'm Wiz. I'm the co-founder and GP at a fund called Spacecadet. We are a $15 million pre-seed fund backed by some pretty stellar people like Mark Andreessen, Alexis Ohanian, Bain Capital, and Google's fund Gradient Ventures. we call ourselves the marketing VC. We help our portfolio companies with marketing, specifically storytelling. We invest at the opposite end of the spectrum. So when companies have zero revenue and often just getting started, and hope to see them along the way to more than $100 million in revenue. But yeah, that's me and that's Spacecadet.
Hey, there we go. You said stellar. I love that. My name is Jonathan. I'm a partner at Expanding Capital. We're a growth stage VC fund. We invest Series B to Series D. Our entry point is 5 million of ARR. We've invested up to 500 million of ARR. Some of our portfolio companies include Coinbase, ClassPass. We actually invested with Manhattan Ventures in Turo. Prior to venture capital, I've been a founder and operator. So I've only been at Expanding Capital for a year and a half. My first company was called Human. We built a conversational AI CRM, and we sold that company to Tinder in 2015. The last 4 years, I've been building another conversational AI company in the customer service space called Snaps. And we got acquired by a larger player called Quick during COVID. And just as a fun one, when I was in college, I started one of the first digital native vertical brands called Soleil Bicycles. So I've been a founder in the D2C space, founder in the consumer app space, built a B2B software company, and now giving venture capital a shot. Good to be here with all of you today. Sorry we don't have any energy drinks.
Hi, I'm Steve Brotman. I run Alpha Partners. It's a growth equity fund. We actually sort of sit between Manhattan Venture Partners and the early stage VCs, sort of between 10 million and 100 million in revenue. Our secret sauce is that we partner with other VCs to generate our deal flow. So, and we share part of our what's known as carry or profits with those partner VCs. So about 95% of the time, it turns out VCs, once they do a seed round or an A round, won't do their B round, C round, D round, F round. And so we slot in and help those VCs out. That being said, we work with 800 VCs. So if you're an entrepreneur, our customers are early stage VCs. The odds that we're 1 degree of separation from an early stage VC are pretty high. And we love sending business plans their way. So if there's a particular VC that you want to die to meet and you have the perfect plan just for them, that's a pretty high bar. You know, you can shoot me a note. So excited to be here. We're an investor in a company called GoPuff. Might be familiar with that. Also, SoCure. Another company that you might have heard of is Roman Health and 30 Madison, which has Keeps. We also do a little bit of international investing. We're an investor in Coupang, the Amazon of South Korea, and Careem, the Uber of the Middle East. So it's been a fun run, and I've been in the industry about 25 years, so I probably would have been in the corner over there. So it's been a fun run, and I'm glad to be here.
That's great. And you're also an advisor to the Pritzker family group, aren't you?
Yeah. No. So I had the good fortune of going to high school with J.B. Pritzker, and he was a few years older, and I was the ad director for a newspaper he founded as a student, like a student newspaper. That's how I got to know him. And he funded me in my first startup getting out of school. And they recruited me to work with their venture fund. And so I work with their venture team.
But these mics need, can everybody hear? Can everybody hear each other here? Or we're good? Okay. Okay, good. Yeah, the Pritzkers, if you're not from here, are like the Rockefellers of Chicago. Is that an accurate way of saying it? Or
I would say they're probably yeah, I would say definitely of Chicago, but they're probably one of the more well-known family offices involved in venture and private equity.
Absolutely.
So probably one of the more preeminent known folks, and they're really, it's great that they're one of the good guys. They got there through hard work and integrity, and backing good people. So it's been nice working with them for 30 years.
That's awesome. So Andrew Roman, 7BC Venture Capital, we We actually had my partner Josh, where we co-founded Rubicon together, said that we were one of only 50 VCs in New York City at the time that we started in like 2011, and now there's got to be 300, 400. I remember flying over New York to go to Boston to get money. Boston was number 2 after Silicon Valley, and then all the VCs showed up right before the .com bubble burst. So they all took their ties off and said, "We're VCs. Here's my food table in Hell's Kitchen." And then it was like when people were getting their MBAs in 2001, it was, you know what B2B stands for now? Back to banking. You know what B2C stands for? Back to consulting. So, no more Harvard going straight into startups and trying to get rich. Well, I think it is pretty wild that we have like the full spectrum continuum from, pre-seed, pre-revenue, all the way up to funky structured late stage. I had Andrea on my podcast the other day, and just like a teaser of what's to come, she said, "My future yacht, the name is going to be No Rofer." Something like that. But Liz, since you're the earliest investor here, so you're investing heavily in New York City, but you're like across the country, aren't you?
Yeah, so we invest about 90% in the US, 10% internationally. Within the US, our 3 biggest cities are New York, San Francisco, and Los Angeles. I think New York probably top, not just because it's an amazing and growing ecosystem, but also because I'm here. I'm going to be moving back to the Bay Area later this year, so expect to see the San Francisco numbers go up. But yeah, mostly US.
Yeah, that's cool. We were talking about that. Talk about how are you valuing a startup right now? So if you're investing in a pre-revenue, pre-product, or you're investing pre-product, if you're investing pre-product, pre-revenue, how many employees are typically there when you're coming in?
So at the pre-seed, the teams that we talk to are usually 2 to 5 people at the most. We do seed as well. Seed is usually 2 to maybe 10 people at the max. We looked at the portfolio recently. Not a lot of difference in terms of progress. The seed investments have been just founders that are second-time founders and can jump straight to seed and raise more money. Or maybe they're a bit further along, but still not by much. Yeah, in terms of how we value these companies, much different than how the other folks on these panel value companies. At pre-seed and seed, there's really sort of like a standard range of valuations. And as long as the company is within, a standard deviation or excuse for it to be outside of that, then it makes sense. At pre-seed, we're seeing valuations anywhere from 5 million to 15 million at the top. Most of them are sort of like 8, 9, 10 is where most of them land, 10 million post. And then at seed, it's anything like $9 million at the lowest to, if you had asked me this last year, it would have been like 35 million. This year, maybe 25.
That's crazy. So you were investing in 35 million.
We did one $35 million company.
We do a little bit of seed on it. I try to keep it a secret. But when someone comes to me and says it's a 35 million pre on a pre-revenue company, I say, so we try to make a 50x on some of these things. Like I've had 54x, 80x. But we say it's got to be minimum 20x for seed and minimum 10x for A or B. And that's why we get pushed out of the C's and beyond. You realize that like if it's 35 million pre, if you 10x that's 350 million. Expect minimum, 50% dilution. So you got to be sold for more than AdMob. And you remember AdMob. You got to get out for more than DoubleClick. It's like, sir, you are no DoubleClick. So I find that shocking that they want 35 million.
Yeah, 35 million is very wild. I'm happy to report that the numbers have come down back to earth in the last couple of years. So today, seed deals that we see are on average 15 million, 16 million. The range there again is like 9 to 20 million today. Pre-seed and seed companies, as long as they fall within that range and they're asking for an amount of money that equals reasonable dilution within those ranges and they can justify that amount of money. Some companies only need $1 million. Some companies need $4 million. Usually the $4 million company will raise at the top end of that range. They're raising more money, but usually they have good reasons to do so. We're working on something really hard. We're working on hardware. We need more time. We need these really fancy engineers. Versus maybe a team in LATAM that pays, $3,000 a month for engineers. All they need is $1 million to get to the next stage. So yeah, within that valuation range, that's sort of how at the early stage we value them, which is probably hilarious to some of these other investors at the table.
I'll probably bore the hell out of everyone if we talk too much portfolio construction, but I'm always obsessed with it. kind of the earlier you invest, the more you need a wider set of companies to neutralize that risk of a singular investment. The more later stage you invest, the more concentrated you can be, and you want a big impact. And the VC's confused that they think they're adding value, and so they want to be all involved in these 7 companies or so. How many companies have you got out of a $15 million fund? How many companies will there be in that entire vintage?
Yeah, so we've got a bit of an outlier portfolio construction as well. We want to do 120 companies.
120 companies over how much
120
time?
over 4 years.
Over 4 years?
Yeah,
Okay. Okay, great.
$100,000 checks, 120 companies.
Okay. Look, I got a million more questions, but let's move on to Jonathan. So, Jonathan, you say you guys enter around C, D, or B sometimes?
Yeah, Series B, Series C, or Series D typically.
And did you say what was the revenue mark that gets you involved at that point?
Yeah, 5 million of ARR recognized, meaning they've got that money in the bank.
Right.
We don't like, we see lots of companies doing defense tech that have these really exciting government contracts that might be worth, $100 million contract, but who really knows if those, kind of unique helicopter autonomous drone platforms will actually be delivered and paid for.
Right. Or GMV.
Yeah.
It's like, I don't care what the GMV is.
Yeah.
Right. Just GMV pay for diapers and payroll? No. But so
Energy drinks though.
What's that?
Energy drinks.
Energy drinks, maybe. So if you've got 5 million now, and by the way, we're in a seismic shift of the world, after the invasion of Ukraine and the death of crypto or whatever, the stock market crashing. How are you right now, as a rule of thumb, where the numbers are maybe driving the valuation a bit? What's the right amount of money a startup should be raising when they've got 5 million annual reoccurring ARR revenue? And what's the building blocks to get to a pre-money valuation?
It's a great question. Yeah, this is a cop-out, but the answer is it depends, right? It depends on what kind of company you're building. A B2B SaaS company hypothetically should be, operating with higher margins. They should be able to have lower burn. We typically not to invest in many companies doing, hardware or infrastructure. We've invested in a few companies like that, and the jury is still out on how those companies end up doing versus some of the other consumer tech companies that we've invested in. There's some things that we're keeping a close eye on right now. Obviously, we're debating the differences between growth and profitability. We're looking at different things like gross margin. We're also spending a lot of time thinking through NRR. Does everyone know what NRR is?
I don't.
It's net retention revenue. So it's basically new sales minus churn plus upsells. Mm-hmm. And so, at that stage, we really, really look for empirical evidence of product market fit. And so if you have a number like 120% NRR, it means that you have the ability to upsell your customers, and there's likely less churn happening in your business. A number like 130 or 140 or 170% NRR, this means you have a really sticky product, your churn is very low, and your team is actually able to upsell. So you have likely a number of new products being offered. One company that we invested in has an NRR of 282%. It's the highest I've ever seen. And it's a really sticky kind of NRR. So certain businesses that we've been staying away from right now. So if you think about NRR, there's certain companies that are built off of headcount-based NRR. This is like software like LinkedIn, right? So they sell seats. And unfortunately, there's a lot of layoffs that are happening. And so we expect to see some churn. It'll be really hard for businesses like LinkedIn, we think, to upsell right now. So we're staying away from those kinds of businesses. There's NRR that's based on volume. This is like Stripe, Shopify. That's pretty sticky NRR. And then there's NRR like Twilio, which is basically volume-based. They make money every time you send a text. That business takes a percentage. So the business that I'm referring to, they charge per text sent in and out, and they also make a percentage of every transaction that takes place. So we're looking for really sticky products, really great NRR, and then obviously all the other aspects of profitability, growth.
So not all revenue is created equal.
Not all revenue is created equal.
Yeah. We make sure we understand what the revenue is. Stephen, you've been around for so long, I can hardly believe that all you do is rely on GPs like me to send you our deal flow that we're out of cash
isn't
for.
that great?
Right. What percentage of your investments are just going direct? Because everybody knows you. I mean,
Not that many actually. I really do. I think it's 95% come from VCs.
Okay.
So like, if that's occasionally we'll get direct stuff, but it's highly unusual. And even then, I'm still relying with a little help from my friends. So for information and access. So yeah, it's a unique model. I decided instead of competing with everyone, we would just work with everyone. So
listen, man, I believe in it. My strategy to make more money and work fewer hours and spend more time at home and not travel as much is do like 15% fund of funds and then cherry pick co-investing with these people and then getting that information. That information is just so key.
We're similar, except we don't have a fund of funds. So
I know you figured out a way to.
We do it at scale. So we'll invest $5 or $10 million in one deal, and that VC, can do pretty well. So, and also what we do is we help that VC find new investors at that stage too. So we're pretty connected in that community. One of the benefits of being old. You just know everyone. So
yeah, and they maybe trust you a little bit. You've behaved well for that long.
Yeah, he's not dead yet.
Yeah. Well, and just make sure everybody understands. I think this is a fascinating model. Is that like guys like me raise a fund 1? Oh, that was easy. Then you got to raise a fund 2. Oh, that was a little bit easier. Actually, being truthful. And then fund 3, you're getting the friends of your friends to begin with, and you're still in the game. And then you're getting into fund 4, and you're trying to get to at some point an opportunity fund that we've got like. Nothing like you, but we have like 75 living startups. So if I invested in Neon Invest at the early stage, and now we've introduced them to Jonathan and all these other great people, and they're raising like 100 on 900 million pre or something. That's not going to give the multiple that my LPs expect. But damn it, if I'm not going to be able to participate in it, and so being able to go to Steve over here and say, "Hey, I realize that I'm one of your 900 VC friends." He's lying. He's got more than that. Like, I'm telling you, it's actually true that if he can put the capital in and I get a little scratch of the carry, that's definitely a good thing. And it's getting closer to exit. It's not a bad business. So that's the way it works, right?
I hope you get a big scratch. So it's we share up to half our carry.
Share up to half the carry. So 20% of the profit on that late stage. If it's a big check, 20% of it might be something, and it's like 2 to 4x probably. Something around that 1 to 3 years.
On a $10 million deal, that could be $1 million, $2 million.
Yeah,
for you.
Yeah, life's expensive, man. Inflation's been hard.
It's worth a 5-minute call. Right. So, yeah. Hey, Steve.
It's also
my best company, my favorite people, and what's fun for me is I get to work with the best people in the industry who really, they're blowing it out. I spent 15 years as an early stage VC. It's a tough job. You spend about 80% of your time, you're burying companies. The last couple of years, it's been pretty slow, but you're an underkeeper as a VC. People think, oh, it's all glorious. But if you even you look at the Midas list, they'll have one company that they're known for. And the 30 or 40 other companies they work with, dust. And, so be kind to your VCs because they spend most of their time, digging ditches. I know it sounds weird, but, that's true.
I sent my first deal to Julian this week, actually. Yeah.
There you go.
So, Andrea, let's talk about the change in the marketplace. So you're playing at, and by the way, the fact that you were a founder and creator of this industry, I think is so wonderful that you're the one landing with the GP.
You were early days too.
We were doing a Founders Club when the secondaries were very rare.
Yeah.
So we figured out how to do secondaries, legally without that. And then I did get into secondary. So when we lost Daniel Elk from Spotify, he told Northstone Grantham he's doing 20 million into the Founders Club. So he's going to exchange equity for LP ownership in 25 companies coming together that had Pandora, Last.fm in the same equity exchange fund. Northstone said, give us a couple of weeks and we'll spin up an SPV and we'll buy the 20 million for cash. We want more. We'll go backdoor if we have to get more of this asset. So that was that. But talk about some of the dynamics of this shift in the market, right? So a bunch of our portfolio companies were early kind of whiz stage, Spacecadet, and then they raised 100 million, 150, 130, in the peak at the summer of 2021 in the spring, and they got those deals done. What does that look like on secondaries right now, and who's selling, and who are you buying from? Oh, wait, can I first say this? What's the difference between a primary and a secondary? I'm not sure everybody in the room knows the difference.
Sure. So a primary is a primary issuance of stock. So that is the stock the company's issuing to investors when they invest in a new round of funding. So that's the Series A, B, C, D, F, G, right? That's the primary. The secondary is the stock that was already issued. So it's the stock that was issued to those investors or was issued to employees. And now it's being, it's exchanging hands between new investors. So it wasn't issued by the company. It was already issued to someone else, and now it's exchanging hands. Overall, yeah, it's brutal out there, guys. I will say, I no longer have to race to invest in a company that's trading at 100 times NTM, even in the late stage. So, even in late stage companies, we were seeing companies that were priced at 40, 50, 60 times next 12-month revenue, still at like a negative 30% EBITDA margin, and telling me they were going to go public in 12 or 18 months. And it was a battle to get into those companies. Nowadays, it's completely changed.
When did the market correct in your mind?
I will say when I started getting worried about it was Q1 last year, when all of the crossover hedge funds called me and said, we're about to get margin called and we have to drop everything. And I was like, really? You guys, like, you need to sell now. Like that was when I started seeing the market shift. But overall, I would say, like, when I started seeing a dip in just generally valuations in the secondary market, and then companies kind of playing the long tail for valuation, was definitely Q4 21 was when I really saw it. But Q1 2022 is when the hedge funds started backing off. So,
but I would agree with that. I would say that spring of 2021 in the summer, was like the peak. Like, this makes no sense. Like, if the company makes $1 million a year and I pay $47 million for it, forgetting discounting cash flows, I got to own it for 47 years to get my money back. That just sounds bad, right? Not to mention interest rates are going up, so you should discount year 47's $1 million payout. But I think it was like by August, people said, I'm not doing this anymore on the investing side. And then by October, deals were getting done at a much more sane, let's say, multiple, like Jonathan's talking about, of getting back to 10x.
Yeah, absolutely. That's exactly right. And I would say, just generally right now, I always like to be very optimistic in this sense. I mean, this is why, in VC, like, you're burying, but luckily in the late stage, there's some level of de-risking, at least you expect and hope, that they're, almost too big to that extent where, okay, they could prove their model, they could pull levers on profitability and revenue to really achieve the outcomes they need. Overall, I will say the companies that are strong companies will always be strong companies. The operators that are strong operators will always be strong operators. I will say, a company that you and I should talk about has a NRR of 400%. So, like, there's definitely strong companies out there that I'm like, in any environment, they're going to thrive. And so I think that focus on the executive team, their ability to recruit, retain talent, to me is extra key, especially in like a world of being distributed for the employee base. Overall, though, like the best companies that raised money in 21, they're telling me that they've obviously reduced burn, they cut costs, they're cutting sales and marketing across the board. That's important. We need to see that there's, like I said earlier, like single digit profitability, like above the line, going into whenever their IPO is going to be, right? And so I would say the companies that I am paying extra close attention to in my portfolio are the ones who were expecting to go public this year, and now they're not, and they're thinking about what they're going to do next and what level of a balance sheet they're going to have going into the next 12 months while we wait to see the IPO window potentially open back up.
I mean, this is what I call the tale of two cities, that for some startups, this is a really rough thing, like seats are being reduced. So you're not landing and expanding with existing logos. You're trying to reduce spend to get the new logos. You're used to delivering 4x growth or 2x growth, and you're trying to get to profitability, and you're finding out that you've got negative unit economics. That's like the tale of two cities you don't want to be in. And then there's these other companies that their software does the job of a human perfectly and better, and it's like people can't afford not to use that technology with their austerity needs. So that's like, there's always going to be a funder in any post.com 2008, 2009 environment. But talk a bit about, and everybody jump in on this, because I mean, you guys are all in the same business, but I want to talk about the bid-ask difference between issuer/seller of the secondary stock. Like we really were counting on some exits, and then 2001 got so frothy that people threw money at them. Founders took big secondaries. I'm like, damn it, they're never going to sell. And then so our exits got pushed back by that. We should have been doing secondaries at the peak more than we did. And then all of a sudden, stock market crash, invasion of Ukraine, crypto's gone. No one's going to IPO at that. No one wants to M&A at those new multiples. So the exits are yet further elusive. Does that mean people want more of doing business on secondaries, or they just cannot bring themselves into the bid-ask zone?
I would say, secondary right now is such an interesting entry point in venture. I mean, of course, if you're going to think about secondary, you have to think about your portfolio composition, because you either have to register as an IRA if you're going to trigger the 20% rule. So there's considerations for doing secondary, but always happy to chat about it. Overall, you can get amazing companies at a discount right now. So like if you were hyped on Databricks, yeah, I mean, now that looks a little bit more affordable, right? So overall, it is a great way to get a piece of the pie of a company that otherwise might have seemed too attainable, too expensive. I mean, 60 or 70% off right now is not out of the question for some of the best companies I've ever seen, which is super, super interesting. But overall, I will tell you, like, where it got really frothy was back in 2020, 2021, where I was seeing companies close a new round of funding. So they closed a primary, like the best companies. And then immediately in the secondary market, their common stock was pricing at like a 10 or 20% premium from the round that just closed, like weeks prior. And that to me was just like the ultimate top of the market for the secondary market. You just would never see that otherwise.
So, prior to 2021, we had never done a secondary investment. And I'll tell you what kind of kicked off our journey looking at that. So, basically towards the end of 2020, 2021, we really slowed down our investment, partially because we weren't seeing many companies. We thought things were really expensive. But then all of a sudden, deals got really quiet. And so we just asked some first principle questions like, why are we not seeing many great companies go raise? What should a fair valuation be? And we weren't really getting answers in a primary round of investing where these are the kind of investments you might read like in TechCrunch, XYZ company raises so much money. So what I started to do was actually build out relationships with brokers. There's a whole other world of investments that are in the secondary world. So there's secondary funds, there's secondary brokers, and there's early funds that maybe want to sell some of their position, or founders or employees that maybe thought they were going to go public. And now obviously that window is closed, but maybe those particular employees want to buy a home or have large bills or have to pay for college. They need some capital. So we just started tracking basically of March of 2022, basically about 50 different companies. And over a 3-month period, we saw the ask price drop on a median of about 15%. And now today, if we look at that data, it's probably about 50% on a decline. And so if you're interested in buying great companies, you can get likely a pretty good price today. One of the things that we're seeing right now is funds that might have been invested in a seed round or a Series A round of a great iconic business. They might have been invested in that company from about 8 years ago or 9 years ago, maybe longer. They need to pay back their investors, their limited partners. And so that fund might be willing to sell a portion of that stake, get some cash, pay back their investors. And we say, hey, we just bought this company at 60 or 70% from its last round, and we think this business could still 3x or 4x. We might not be right there, we might be, but we still think there's some good upside. So hopefully it's a win-win situation in those cases.
And that's great for guys like me and Wiz. If we were in that at 4 million or 8 million or 12, even though it took a haircut from 2.5 billion down to 1 billion, we're still at 1 billion. Back in the 90s when we were doing deals, 300 million was considered a win on the NASDAQ.
Zappos got sold. No one could believe a startup was sold for $1 billion. I get that. It was 2009.
Yeah,
it was a big deal when Zappos got sold.
Yeah, rest in peace, that guy. So Steve, I was going to say, talk about how long would due diligence last before the crash, and what does due diligence look like now in your experience? You know what I'm talking about, right?
Due diligence.
Wait. If you're going to do that, then we're not going to talk
That's
to
my
you.
line.
No, I mean, I think, I think due diligence. Well, for what stage? So that's important too.
It's a good question.
And
But I like everybody to weigh in, and it's sort of interesting.
It does depend on the stage. So like, what is you due diligence for two people in a room with a paper napkin? What's the diligence line for that? It's just make sure that they're not criminals. Okay, check.
ISIS check, Al Qaeda check.
We don't do that.
Okay, see, there you go. There you go. I mean,
sounds
that's a
expensive.
better. So you should probably just go down the line, like like how much due diligence do you. But no, I mean, back in my day, there was probably a couple months of diligence, sort of pre 2008, and I'd say today, I'd say pre regime change, if you got like a week or two, I'd be pretty surprised. Although some of the bigger firms were spending, a decent amount of time, it varied depending by partner, and so that's it was highly dependent on the firm and the sector, and the stage. So not to cop out. Today, though, I get the sense that people it's going back to normal. A month or two of diligence, kicking the tires, especially at the growth stage. 2/3 of all growth stage investors. She mentioned the hedge funds not answering her call. Well,
They were the ones calling us. That was just scary.
Yeah, the crossover guys were trying to cross back where they belong.
Yeah, right. So about what people don't quite realize is that there's the venture industry, and then there's the tourists. Those are the folks who come in and out of the market, and so a huge number of hedge funds were sort of crossing over and sort of arbitraging the private market to the public market. Further, mutual funds were getting into this, sort of the T. Rowe Prices of the world. Yeah, they'd say, "Hey, we have $1 trillion. Why don't we put 100 million in we're going to have to buy at the IPO anyways, and we're not going to get an allocation, and the stock's going to go to the moon. So let's take a position in, say, LinkedIn before it goes public."
I remember Carl Icahn and Fidelity invested in Lyft. Lyft went out for 300 and came back with 650.
Right.
And I met a guy who worked for Carl Icahn, and he said they did 100 billion into that round and made some was that 100 million? Oh yeah, sorry, 100 million. But they made a sensational exit on just that with Lyft.
Yeah.
So they're going to go back to that bar again.
There's a lot of that. So,
Andrew, we're going to weigh in on the change of how long it takes to get a deal done.
Well, I was going to say, first of all, actually, I just want to give props to Alpha Partners and Steve, because we've also partnered with him. So co-investors, 2 co-investors here, which is awesome. But I was in due diligence right now. Like, we're spending real time. I mean, it is significant. I mean, we're doing the reference checks, and we're doing customer reviews. I will say I bring in lawyers to review the MSAs and SOWs now of the companies. And I will tell you, it is alarming how many blockchain companies have terrible MSAs. So just FYI, like
lack of governance.
Yeah, I mean, it's just terrifying. So just overall, like even in the secondary market, historically, it's been known that you have to kind of rely on a lot of public comp data, or just very little information, because companies don't always open their kimono as much to secondaries. They historically did primary. Where we sit is that because we have a venture fund, we've raised 4 funds, we have almost $2 billion under management. Like, we're underwriting the deal, and then we're giving those financial models to our LPs, and we're saying, this is where we price it. This is our base bill and bear case. And if we're then kind of wearing our like broker hat under our broker dealer, we're being very transparent and saying, here's how we'd underwrite this deal. So we're doing that for every single opportunity, so you can understand like principally where we price things relative to where we think the market is. And I think that like level of visibility is something that you haven't always been able to have in the late stage.
All right, so I'm almost ready to stop moderating and let you guys ask questions. But Andrew, explain what a rofer is, and since that's the name of your future yacht. And do people stop rofering you lately?
No rofer.
No rofer.
No ROFR. Yes, this is amazing. So a right of first refusal is a provision in shareholder agreements, bylaws of startup companies. The right of first refusal is this provision, a contractual provision that when you want to exchange your shares, you want to sell your shares of a private company. Private companies remain private because they want to select who their investors are, and they want to manage the cap table. They want to manage that pricing of the company. That's why you're private. So the right of first refusal typically protects the issuer and says, hey, if you're going to sell your stock before we go public, we as the issuer reserve the right typically to buy it back from you first. And if not, we're going to take it to a subset of other investors, typically the board, if not some other major investors, and then they can buy the shares back first as well, or they buy the shares from you. So it's this really fun thing I get to navigate every single day, which is, are we going to get ROFR'd? Because we're usually that new capital coming in, and we have to, obviously navigate that and say, is it likely that if we're going to, tie up our capital and invest in this deal, are we going to be, blocked at the ROFR stage? And quite frankly, if I do get ROFR'd, it's a really good sign, typically. That means someone wants that stock so much more than I do, and I'll just have to try again later.
That's why I always worried if you didn't get ROFR'd, you overpaid, or you better have some conviction, because you got through every single major investor, chose not to exercise a right of first refusal, and the treasury of the company chose not to ROFR you, but in a world where they can spin up the SPVs in 45 days.
Sometimes the existing investors just they're fully allocated. They're just like, we have enough exposure, we're done.
Time to do an SPV with your LPs then.
But
that's a pain, and not everybody. It used to be that every VC was too lazy to do it; they didn't even care.
I usually have to call the board, and I'm like, please don't ROFR me.
And also you have the ability to do a primary, so you can say like, ROFR me, and you don't expect us to do what we can do for the primary round. Yeah, that's rough muscles to not get ROFR'd. I think that's interesting. Okay, so if anyone asks a question, our one request is that if you pitch your company, you'll be asked to leave right away. You can pitch your company later. And we don't have a mic runner, so I'll repeat your question, and then these guys will answer it.